Hey everyone, welcome to Trading with Precious, your go-to channel for everything Forex. If you have ever wondered what Forex trading is, how it works, or how to start trading today, you are in the right place. This video is your step-by-step guide to Forex trading in 2025, perfect for beginners. Let's dive in. Before we dive into the meaning and the explanation to Forex trading, what you are seeing on your screen now is our graphic representation of the Forex charts, where we have candlesticks. Forex trading. Forex stands for foreign exchange, which means trading currencies like USD, which is the United States dollar, GBP, Great British Pounds, Euro, JPY. It is the largest financial market in the world, with over $6 trillion traded daily. The Forex market belongs to the financial market, where we have crypto trading and the likes. Forex basics you must know. In this video, I will be explaining the pip, spread, lot size, leverage, and currency pairs. Pip, which stands for price interest points, represents the smallest change in a currency pair. Typically, it is the 4th decimal point, although many brokers quote using the 5th decimal. However, the 5th decimal does not really affect the price, as it changes really quick. Currency pairs that include the US dollar. A pip is 1 to 10 of a dollar, whereas the currency pairs includes the yen. A pip is 1 to 100 of a yen, because the yen is closer in value to 1 to 100 of other major currencies. Now in the next slide, I will be explaining in details what the pip is. The picture on your screen is an explanation to the pip. And we also have what we call a pipet, but it's not really common. It's not common at all. Pipet is the 5th number after a decimal point, while pip is the 4th number after a decimal point. That is when trading the major currencies like the USD dollar, dollar-related pairs. But when trading pairs like the yen, like GBP, JPY, USD, JPY, and all that pairs that are related to yen, the pip is the 2nd number after the decimal. But for currency pairs like the USD dollar, now the pip is the 4th decimal, the 4th point after the decimal. Now in this example, the euro is the base currency, the USD is the quote currency, and the value there is 1.3505. The 4th number after the decimal is the 5, which is the pip, while the next number, like a subscript, is the fractional pip, which is still the pipet. The value you are seeing on your screen, which is 1.3505. Let me explain what it means. It means that for every euro, for 1 euro, you need 1.3505 of the USD to buy the euro. Just as I explained in the previous slide, that Forex trading has to do with buying and selling of different currencies. So if you are spread in Forex trading, brokers quote the bid and the ask price for the currency pairs. The bid is the price that a trader can sell the base currency, while the ask is the price that they can buy the base currency. Spread refers to the difference between two prices. Besides, this is how the no commission brokers, those who do not charge a separate fee on traders' transaction, make their money. The spread is measured in pips. Most currency pairs, that is the base currency and the quote currency, have a pip value equal to 0.0001. For instance, take the following quote: Euro USD equals to 1.1051 to 1.1053. The spread is 0.0002, which equals to 2 pip. When you hear of big, what should come to your mind is the selling price, which is the amount a trader is willing to sell a particular currency. And when you hear of axe, what should come to your mind is the buying price, the amount a trader is willing to buy a particular currency. So now the difference between the selling price and the buying price is what we call the spread. Now brokers make money from spread. Brokers, that is the no commission brokers, broker that does not charge you commission whenever you make any transaction or any trade. That is how they make their money. The difference between those prices is how they make their money. So spread is the difference between the buying price and the selling price. Lot size. Lot size in Forex refers to the number of currency units you are buying or selling in a trade. It determines the volume of your position and directly affects your profits or loss per pip. Why it matters? Why lot size matters? The bigger the size, the bigger the profit or the loss. And it also helps in controlling risks and position sizing. Lot sizes in Forex trading. There are 4 types of lot size in Forex. The first is the standard lots. Second is the mini lots. Third is the micro lots. And the fourth is the nano lots. Now to the standard lots. 100,000 units of base currency. That is to say, for each pip movement, you are either making a profit of $10 or you are making a loss of $10. Mini lots, 10,000 units of base currency. That is to say, for each pip movement, you are either making a profit of $1 or you are having a loss of $1. Micro lots, 1,000 units of base currency. That is to say, for each pip movement, you are either making a profit of 0.1 profits or having a loss of 0.1. Nano lots, 100 units of base currency. For each pip movement, you are either having a profit of $0.01 or having a loss of 0.01. So for example, now the standard lot size, we have it is from 1 lot size to from 1 lot size and above, 1 lot size, 2 lot size, the 3 lot size, the 4 lot size. All these are the standard lot size. While for the mini lot size, we have the 0.1. From the 0.1 to the 0.99 is the mini lot size. While the micro lot size, we have the 0.01, 0.01, 0.02, 0.03, 0.04. So, but as for the nano lot size, it is not available in some brokers. But I believe those trading synthetic, the derivative traders, you can trade 0.001. That is the nano lot size. Leverage in Forex. Leverage means the use of borrowed funds to increase one's trading position beyond what would be available from their cash balance alone. So now leverage is a borrowed money from your broker. It's like your broker borrowing some amount of money to allow you trade, to allow you open big positions, even with little capital. For example, now there's what we call the cent account, which most brokers have. Cent accounts where where the broker multiplies your balance by 100. For example, if you fund a $10 on your cent account, Now the broker multiplies that $10 times 100. 10 times 100 is what? Is 1,000. So in your balance, you will be seeing $1,000 in your balance. Meanwhile, you just have a life funded account of $10. So now the broker is helping you to open big positions with just your $10. So it's leverage is like a borrowed money from your broker that allows you to trade, that allows you to open big positions even with little capital. The major currencies in Forex: USD, which is the US dollar; Euro, the Europe; JPY, Japanese yen; GBP, Great British Pounds; AUD, Australian dollar; CAD, which is CAD, Canadian dollar; CHF, Swedish francs. So these are the major currencies in the Forex markets. Minor and the exotic currencies in Forex. The minor currencies: we have SEK, Swedish krona; NZD, New Zealand dollar; NOK, Norwegian krone. Exotic currencies: MXN, Mexican peso; ZAR, South African rand; TRY, Turkish lira; and HKD, Hong Kong dollar. And there are so many other exotic and minor currencies that I have not mentioned. So, but during the course of the training, we will not be paying attention to most of these exotic and minor currencies. We'll be using basically the major currencies. What I just finished explaining was the major, the minor, and the exotic currencies. Now to the major currency pairs. We have the Euro USD, which is the Euro versus the US dollar. We have USD JPY, USD versus Japanese yen; GBP USD, British pounds versus US dollar; USD CHF, USD dollar versus the Swedish francs; AUD USD, Australian dollar versus the US dollar; USD CAD, USD versus Canadian dollar; NZD USD, that is the New Zealand dollar versus the US dollar. Major currency pairs are pairs that are related to the US dollar. So have it in mind. Major currency pairs are pairs that are related to the US dollar, like the USD JPY, GBP USD, Euro USD, AUD USD, NZD USD, USD CAD, USD CHF, and the like. So these are the major currency pairs because they are related to the US dollar. Tools you need to get started. First is a reliable broker, e.g. we have the XNES, IC Markets, OctaFX, HFM, Just Markets, W Markets, Oanda, and the likes. And you need a trading platform like the MetaTrader 4 or the MetaTrader 5. You need a charting tool like the Trading View where you do your analysis, and the demo accounts to practice, which is free and risk-free. So in subsequent videos, I would explain how to navigate your way through the MetaTrader 5 and how to use the Trading View. Mistakes to avoid. Before you start, avoid these common traps. One is over leveraging. Many traders do over leverage. Many traders over leverage a lot, and that is why they have remained unprofitable. But in subsequent videos, I will explain what it means to over leverage and also risk management. So most traders do not have a good and a precise risk management rules. Number two is revenge trading. Many traders do revenge trading. That is whereby after losing to the market, they want to gain back what the market took from them with impatience and with greed. So revenge trading is very bad. That is the cost of blowing account. Most traders have blown their account because they are trying to revenge trade, because they are trying to gain back what the market took from them, with impatience, with greed, with no trading plan. Now this takes me to my third point, which is no trading plan. Some traders just open the chart, and when they see that the candle is going up, when they see that the market is going up, they'll buy. When it is coming down, they sell. That is without having a clear and a precise trading plan. So with no trading plan, you can't be profitable. You are just trading blindly. It's just as if you are gambling. So if you don't have a trading plan, Forex becomes a gamble to you. You become a gambler. Forex becomes a gambling. But when you have a trading plan, when you have the skill, it becomes a business now, not a gambling stuff. Now the fourth one is skipping demo accounts. Many people tries to jump the process, which is very bad, which will surely hurt them either now or in the future. So it is advisable, as you are starting out as a newbie in the Forex industry, in the Forex market, it is advisable you practice with a demo account, so as to understand how the business works, so as to understand the skills, so as to gain the knowledge, to gain and to practicalize it before you move into before you start trading live funds. So you must be sure that you have learned this well enough before you start trading live funds. If you found this helpful, please hit the like button and subscribe for more weekly trading contents. Drop a comment if you are just starting. I would love to hear where you are watching from, or what's your biggest Forex challenges. See you in the next video, and remember, consistency beats speed in trading.